Today we're covering one of the most popular strategies floating around social media and seminars, the Augusta Rule. It's often pitched as an automatic free deduction if you rent your house to your business. The reality, it works in very narrow circumstances, and for most business owners, it's not nearly as good as it sounds. Now, my disclaimer before we get started is this is not tax or legal advice. Everyone's situation is different, so consult your own professional. And if you're watching this and I am your professional, I'm happy to schedule a consult to talk with you about your specific situation. So let's start with the basics. The Augusta Rule is an IRS provision that allows you to rent out your personal home for up to 14 days per year and not report that rental income on your tax return and not pay any tax on it. This came about because of the Masters Golf Tournament in Augusta. People were renting out their homes for a week or two, and technically they were supposed to file an extra schedule and report all the income. But for such small occasional rentals, the paperwork burden was bigger than the revenue to the IRS, so the IRS said, fine, up to 14 days a year, you can rent your home and it won't be taxable. It's a really good simplification, but it was designed for people who are occasionally renting out their homes, not as a loophole for business owners. Now, even in the exact scenario that this was designed for, say you rent your house for a week during a major event, there are some hoops you got to jump through. Insurance. Is your property covered if strangers stay there? HOA or lease rules. Do they even allow you to do short-term rentals? And logistics. If you are having someone stay at your house, you need somewhere else to stay. You're taking risk of damage, theft, or just hassle. It's not free money. It's a trade-off. Here's where I get the question a lot, though. Can my business rent my house for retreats or meetings, pay me rent, deduct the expense, and I don't pay tax on the income? That's the pitch. On Tax TikTok or at a seminar, it sounds amazing, a deduction for the business, tax-free income for you, but the reality, it's much more complicated. First of all, business purpose. Expenses are only deductible if they're both ordinary and necessary. That's the IRS's rule. You can't just manufacture a deduction to save taxes. So if your company already has office space, what's the compelling reason to hold meetings at your house? If you can't answer that, then this doesn't work. Documentation. Now, if you go this route, you need an actual rental agreement, actual payment from the company deposited into your personal bank account, agendas, minutes, attendee lists for the meeting, evidence that the meeting couldn't reasonably have been held elsewhere. And the last point is key. If you have office space or a cheaper, more practical option, you need a real business case for using your home. Without it, the IRS is not going to buy this deduction. Next thing to consider is the fair market value. The rent must be reasonable for the business use of this home, not Airbnb pricing. The IRS will compare it to conference rooms or other meeting venues in your area. If your house is massive, but you're using it for a 4-person retreat, a huge daily rent isn't defensible. Administrative follow-through. Your business may need to issue a 1099 to you for the rent. Forget that step, and the penalties can exceed the tax benefit. Now, let's say renting a local meeting room costs $1,000 a day. Your business decides to hold 4 quarterly retreats at your house, charging $1,000 each time. That's $4,000 in business expenses. If your marginal tax rate is 24%, the savings is just under $1,000. Now, if you end up only holding 2 of these retreats and you're in the 10% bracket, let's say, you've only saved $200. That might sound nice, but is it worth actually hosting the offsite retreats in your house each year, having staff in your home, doing the extra bookkeeping, agreements, payments, and 1099s, and exposing yourself to IRS scrutiny and an audit? Often the answer is no. And this isn't just theory. In Sinopoli versus Commissioner Tax Court Memo 2023-105, you can look it up. The tax court disallowed most Augusta Rule deductions because the meetings weren't substantiated and the rent was excessive. The IRS and the courts look at those arrangements very closely. As we wrap up, keep these things in mind. Don't let the tax tail wag the business dog. My most successful clients aren't chasing little gimmicks that add friction to their businesses. They're too busy making money and running their companies. Focusing on growth beats contorting yourself into a marginal tax play. Remember the paper trail. Agendas, minutes, sign-in sheets, slide decks, all of it. And yes, you must actually pay yourself from the business and deposit the funds. Mind the reporting. Don't skip the 1099 if one is required. The penalties are real. Now, I actually like the Augusta Rule, especially in its original form. It's a humane, sensible provision for people renting their homes occasionally. But as a business tax hack, it's a very narrow lane. For most small businesses, the cost, hassle, and audit risk outweigh the modest savings. If you found this helpful, please share it with other business owners you know. In the meantime, don't let the tax tail wag the business dog. See you next time.